Has Brent Johnson's dollar milkshake theory begun? And if so, will it crush the global economy? I'm going to do my very best to answer that question for you right now in 3 simple, fast steps. Step number 1, let's go over how the dollar has been exploding higher recently. We've got a chart of the DXY just going back about 6 months, and you can see how it kind of flatlines, but then recently, especially since Russia invaded Ukraine, it has gone straight up. On the left, we go from 94 all the way up to 102. So back about 6 months ago, it was about 94, and today we're at 101, all the charts indicating that it's going to continue to go higher. But as most of you know, the DXY, the dollar index, is just a measurement of the dollar against a basket of other currencies, mostly the euro, about 57%. So the question really is, what is the dollar doing against these other currencies specifically? Before we get into that, let's go to a broad overview of the dollar milkshake theory from Brent Johnson himself and my good buddy, Anthony Pompliano. Editor, let's cut to the clip.
I think that we're going to go through the biggest short squeeze in history. And what I mean by that is I think the US dollar is going to get squeezed much, much higher. And it's going to get squeezed much, much higher because despite the fact that many people don't like it, would prefer to have an alternative, that they just don't. And the rest of the world, the US and the rest of the world has taken out an incredible amount of US dollar debt. That debt either gets paid off, serviced, or defaulted on. And the only way that that isn't extremely dollar positive is if it gets paid off. I don't see how it can get paid off. There's just not enough dollars to go around. But the demand just to continue to service it continues to put a bid under the dollar. And if it gets defaulted on, defaults, while it may decrease demand, it actually destroys money. And what I mean by that is in a debt-based monetary system where money gets loaned into existence, a default actually makes money disappear. And it starts a chain reaction all the way back to the collateral, which was the original basis of which everything was loaned into existence. So even if you have defaults where demand falls, supply falls even faster. So whether people continue using the dollar and are able to service it, I think that puts a bid under it. Or if they start defaulting on it because they can't pay it or don't want to pay it, we get a supply shock and the dollar goes higher. I can't figure out a scenario. Actually, I can figure out a couple potential scenarios where it would go lower, but I just think those are very low-level probabilities.
So we are going to discuss the dollar milkshake theory in more detail throughout the rest of this video. But basically, we have all of this global dollar-denominated debt, and this creates demand or a bid for the dollar. So the dollar goes up because of something like Russia-Ukraine. This presents a scenario globally, the global monetary system, the global economy, where we have less dollar liquidity, we have less dollar cash flow to service the dollar-denominated debts. What happens, these foreign entities sell their currency to get the dollars they need. This makes the dollar go up even higher. So if the dollar is going parabolic against other currencies, that incentivizes people in other countries to invest in the United States. Believe it or not, things like treasuries, more on that in just a moment. So foreigners going into US assets, they need to exchange their currency for dollars to buy the dollar-denominated assets in the first place, which makes the dollar go even higher. So you have this feedback loop, or this doom vortex, if you will, this doom loop, where as the dollar goes higher, all these things come into play that incentivize market participants to push the dollar higher, to buy dollar assets. And throughout the global economy, there's less dollar liquidity and cash flow to service the existing dollar-denominated debt. Now, I know a lot of you right now are saying, yeah, George, I get it, but what about Zoltan Pozsar and Bretton Woods III and Luke Gromen and what's happening with the dollar losing reserve currency status? It's a very good point, and we're going to get to that in step number 3. But before we do, let's go back to those specific currencies and what they're doing lately against the dollar. So editor, let's go ahead and throw up some one-year charts. Let's start with the Canadian dollar, down. Aussie dollar, down. British pound, down. The euro, down significantly. And the yen has absolutely tanked in the last couple months against the dollar, meaning the dollar has skyrocketed in value against these major global currencies over the last 6 months, which would lead one to believe that maybe, just maybe, Brent Johnson's dollar milkshake theory has just begun. And if the dollar going up against other fiat currencies prevents the global dollar denominated debt from being paid off, the global economy will collapse. Step number 2. Now let's go over global monetary policy and see how the United States and the dollar might be the cleanest dirty shirt in the hamper. And this might lead to the dollars being sucked up like a milkshake, with the United States reducing dollar liquidity, dollar cash flow globally, which could present a big, big problem moving forward. The start or the transition into Brent Johnson's dollar milkshake theory. So let's start with a chart of the 10-year Treasury going back about a year. Go to June all the way to today's date. On the left, we go from a 1.25% interest rate up to 3% interest rates. Now we start off going down into August, we go up, but recently it has gone straight up, meaning the yield. Now, I shouldn't say straight up because it's come down a little bit, and the yield curve with the 2s and the 10s did invert the other day, but it's steepened out lately, and the 10-year Treasury as of today is about 2.7%. So let's compare that to some other alternatives for these huge pools of money outside of the United States. You could go into a German Bund 10-year at 0.8%, or some Japanese government debt 10-year at 0.2%. You see, this is what Brent Johnson is saying, and this is one of the points he makes, that although the United States has a lot of problems, and the dollar definitely won't be the world reserve currency forever, as of right now, it's kind of the TINA trade. There is no other alternative. So let's go over how this works in practice. We've got company or corporation XYZ outside of the United States. We'll say they are in Japan. We've got their balance sheet, assets on the left, liabilities on the right. Now, I know this is hard to see, but this is a green box with an L in it, with a dollar sign. I did that to represent a dollar-denominated loan, or this is dollar-denominated debt they owe the bank. Assets on their balance sheet would be Japanese yen in this case. So this corporation says, boy, I've got all this dollar-denominated debt, and I see what the government is doing here. By the way, the Japanese government is doing stimmy checks for gas, and the Japanese yen is collapsing, like we saw in step number 1. So XYZ Corp says, boy, I don't want anything to do with that. I need my assets to match up with my liabilities. So I'm going to buy some treasuries because they're yielding 2.7%. And on a JGB, I can only get 0.2%. And I think the Japanese government is even more insane, or the Japanese government, the central planners combined with the central bank, they're even more insane than their counterparts in the United States. I know for Americans, that's tough to believe when you look at Jerome Powell and Joe Biden. But believe it or not, all the central bankers and all the politicians are completely off their rocker. So going back to Corporation XYZ, they've got this yen on their balance sheet, but they need dollars to buy the treasuries in the first place. So they go into the FX market and they swap out the yen for dollars. Well, let's think about the counterparty. Let's just assume for a moment that it's an international bank, a bank in the Eurodollar system. To begin with, they have dollars on the asset side of their balance sheet. But remember, they sell those dollars to XYZ Corp for yen. So to begin with, they've got dollars. When the transaction is concluded, they have Japanese yen as asset on their balance sheet. Very important that we make that distinction. More on that in just a moment. So XYZ Corp takes those dollars they now have that they traded the yen for, and they go into the US Treasury market and they exchange them for treasuries. So now their balance sheet on the asset side has US Treasuries denominated in dollars and the dollar-denominated debt is still the liability. Well, let's hit the pause button for a moment and think through what just happened. Yes, it is true that XYZ Corp now has treasuries as assets on their balance sheet, but the bank that was providing global dollar liquidity now has fewer dollars on their balance sheet. Those dollars got sucked up like a milkshake by the United States and them having interest rates at 2.7% compared to 0.8% or 0.2% in Japan. When you combine that with the fact that all these global corporations have so much dollar-denominated debt, when we go back to that feedback loop, the doom vortex we discussed in step number 1, it starts to make a lot of sense. So the dollar goes up, which reduces the dollar cash flow, the dollar liquidity in the global marketplace. And those corporations have to exchange their local currency for dollars, which drives the dollar demand even higher. And as that demand goes higher, as the dollar appreciates against their local currencies, it makes the treasuries or dollar-denominated assets even more attractive. Well, if they become more attractive, then those entities outside the United States need dollars to buy those assets, which creates more demand for dollars, which drives the value of the dollar against those local currencies even higher, which reduces the global dollar liquidity to service the outstanding debt in the first place. And like we said in step number 1, if the debt can't be serviced, the whole house of cards comes crashing down. But I know a lot of you right now that are watching this video are saying to yourself, George, that is absolutely crazy. Who in their right mind would want to buy a U.S. Treasury? None of this makes sense to me at all. So insert everyone's favorite Goldbug Bob. And he is really mad at me right now because he says, George, look at the 10-year Treasury. Look at the dollar. It's turning into toilet paper. We're going to have hyperinflation in the United States. Who on earth would buy these treasuries? There's such a negative real yield. And Goldbug Bob has a point. If you're an American and you buy a 10-year Treasury at, let's say, 2.7%, that is a negative real yield relative to the CPI. And that's, of course, the amount of inflation that the government admits to, which is understated tremendously. But you've got to understand that XYZ Corp isn't buying stuff denominated in dollars. Their payroll is in Japanese yen. And when they go out to buy McDonald's or when they buy a car, let's say, or a building for their corporation, they're going to need yen. It's going to be denominated in yen. So they don't care if the cost of goods and services in the United States is going up relative to the dollar. Said another way, they don't care if the value of the dollar relative to goods and services in the United States is going down, because they're not buying stuff denominated in dollars. They're buying stuff denominated in yen. Therefore, the only thing they care about is the cross rate between the United States dollar and the Japanese yen. And the next argument, which is very good, is the government is running these huge deficits, George. I mean, look at this. In 2020 and 2021, we were sending out stimmy checks to everyone, and M2 money supply went absolutely parabolic, and I would agree. But let's fast forward to what is actually happening today. The United States has pulled back that deficit spending, although it's still absolutely obnoxious. I'd be the first person to admit. It's not like they're running a surplus or anything. But let's look at these headlines from Japan. What are they doing to combat the energy inflation? They're sending out stimmy checks, the exact same thing that we did in 2020, but for a different reason. But I can almost guarantee you it will have the same effect, which means the yen going down in value against goods and services locally. In other words, CPI inflation increasing in Japan, which would incentivize them even further to own dollars on their balance sheet, especially if their liabilities are dollar-denominated debt. And the next main argument that I'll get from Goldbug Bob is, George, the United States is going to do QE infinity. It's never going to end. And they're going to keep increasing the size of the Fed's balance sheet. They might be taking a break right now, but as soon as the market crashes, they'll go right back to doing $120 billion a month worth of QE, and their balance sheet will go from $10 trillion to $15 trillion to $20 trillion. On top of that, your drunk, insolvent Uncle Sam is going to deficit spend like the drunken sailor he is. So why on earth would you want to own a treasury when Janet Yellen is going to make the money printer go burr, but instead of producing cash, and her to go and throw up that gif of Jerome Powell, she's going to be doing the exact same thing with treasuries. So it just doesn't make sense at all to hold something that they're going to be producing so much more of. The supply is going to increase dramatically over the next year, 2, 3 years, etc. And again, I would agree, but you have to ask yourself, compared to what? It is true that Jerome Powell and Joe Biden or Janet Yellen are going to do everything that they can to increase M2 money supply, blow the deficits out through the roof, and do more quantitative easing. But what is Europe going to do? The exact same thing. What is Japan going to do? The exact same thing, but probably to a greater degree. Let's remember that right now the Fed has reduced quantitative easing down to 0, and they're talking about doing quantitative tightening. But what are they doing in Japan? They're doing more QE. What are they doing in Europe? They are still doing quantitative easing. So when you remember that the dollar is simply just a fiat currency that's value is relative to other fiat currencies, when we go back to the dollar index or the DXY, it makes sense as to how the dollar can continue to go up against other global currencies. It would make the burden on these global entities far greater to pay back their debt. And if they start defaulting on the debt, this is what could trigger the doom vortex where the dollar just goes higher and higher and higher and the global economy goes lower and lower and lower. Step number 3. Now let's go over the end game and try to answer the question, has the dollar milkshake theory begun? And more importantly, will it crush the global economy? For a moment, let's go back to the balance sheet of the corporation we had in step number 2, XYZ. And remember all of the Goldbug Bobs, I think it was, they were really mad at me because they just didn't understand how on earth anyone would buy a treasury or anyone would want to own the United States dollar. And they believe that the dollar is going to turn into toilet paper, so you've got to go out and buy some gold. And what's interesting is I actually agree with them. I think that you should buy gold, but I don't know that the dollar is going to toilet paper on the DXY, meaning I don't think the dollar is going to decrease significantly in value over the short term against other fiat currencies. But that isn't to say that the dollar isn't going to substantially lose value against goods and services right here in the United States. So what most people do is they conflate the DXY and the CPI. The first step is to stop doing that. That's going to lead to a lot of errors. You have to disentangle the two. You've got to compartmentalize them and understand that just because the dollar is going up against the euro or the Japanese yen, it doesn't mean that we have deflation in the United States. We can have significant consumer price inflation, which we've seen over the past 6 months, while the dollar on the DXY is going parabolic. Or another way to look at this is we could have massive domestic consumer price inflation while the dollar milkshake theory is playing out globally. Check this out. So going back to this balance sheet of XYZ, remember we had the yen as assets and then we had the dollar denominated debt as liabilities. Well, insert this guy. It's not Goldbug Bob, but it is his cousin. That's right, Bitcoin Bug Bill. And he is just as mad at me as his cousin Bob was. So he says, George, I'm so mad at you after seeing this video. I'm going to show you. I'm going to go ahead and sell my treasuries. I've got some T-bills or some maybe 10-year treasuries on my balance sheet along with my Bitcoin. And I'm going to sell them because no one wants to hold on to these stupid treasuries along with your dumb dollar milkshake theory and Brent Johnson. So XYZ Corp says, okay, Bill, we'll go ahead and buy those treasuries for you. So remember back in step 2, they take the yen, they trade them for dollars. They take the dollars, they give those to Bill. And then Bill gives his treasuries to XYZ Corp. And like we said, XYZ Corp gives those dollars to Bill. Well, look at how Bill's balance sheet has changed. He went from having treasuries and Bitcoin as assets, but now he has what? Bitcoin and dollars. So you see what just happened. Because of this transaction, the non-bank entities in the real economy have more dollars on their balance sheet. That means there's more dollars, more M2 circulating in the United States chasing goods and services. You see, so because the dollar milkshake theory was playing out with corporation XYZ, now there are more dollars chasing goods and services in the United States, which means this gives an additional tailwind to consumer prices of goods and services here in the United States continuing to go up. So once you start to understand the mechanics, it's easy to see how the dollar can go up on the DXY while at the same time consumer price inflation in the United States goes up at an even faster rate. But then there's still that outstanding question as to what degree are these foreign entities going to be incentivized to continue or maybe buy more dollar-denominated assets in the future. As an example, let's go to Rebel Capitalist Pro. This is my online investing forum where the members can ask questions and the pros, and myself included, try to answer those for them on live stream Q&As. And in this last live stream Q&A I did, I got a question from a Rebel Capitalist Pro in Turkey, and I think it illustrates the dollar milkshake theory perfectly. So let's imagine for a moment that you're this Rebel Capitalist Pro member that lives in Turkey. Here are the stats from the country right now. They say the official CPI year over year is 60%, 60. But they go on to say that the Turkish government is pretty much like the US government in that they understate the CPI tremendously. So they say the official CPI is 60%, but the unofficial CPI is 150%. But yet their 10-year government bond, the equivalent of their 10-year treasury, is trading at 21%. So think about that. That's a negative 130% yield. And their central bank interest rate, which is basically the equivalent of our Fed funds rate, the overnight rate, is at 14%, while their official CPI is at 60% and the unofficial is at 150. So you think we've got negative real yields in the United States. This is nothing compared to what's going on in Turkey. And I think Brent would make the argument that it's starting in Turkey now, but we're going to see this occur in more and more countries into the future. So again, put yourself in the position of this Rebel Capitalist Pro member in Turkey. What do you do with your money? And you may be saying to yourself, well, George, I'd put it into the stock market immediately. Okay, well, we've got data on that as well. The Turkish Stock Exchange, comprising of the top 30 stocks, performed around 36% year over year. So again, 36% compared to the actual CPI at 150%. So you're still losing massive amounts of purchasing power. Now we go to a topic that Goldbug Bob is really going to like. That's for sure. Gold against the TRY has performed 91% year over year, beating the official CPI, which again is 60%. So it starts to become very clear that if you're in this position, you either buy gold or you buy the dollar or you buy a dollar-denominated asset. And this reminds us that part of the dollar milkshake theory is the dollar goes up against other fiat currencies. But another part of the dollar milkshake theory is gold goes up at the same time. And this is one of the main reasons why personally I'm very bullish on things like gold and commodities over the long run. And if you want to check out Rebel Capitalist Pro, which obviously everyone should, and oh, by the way, Brent Johnson is one of the Rebel Capitalist Pros, you can do that at georgegammon.com/pro. You can take your investing to the next level by learning from people like me, Lynn Alden, Chris McIntosh, Brent Johnson, just to name a few. So to answer the question, has the dollar milkshake theory begun? I think the easy answer is yes, absolutely. In fact, it began a long, long time ago. See, what we have to understand is these forces are at play all the time. It's just like inflation and deflation. It's like these tectonic plates that Jim Rickards talks about. So let's say this green line is the pressure, the upward pressure on the dollar on the DXY because of the dollar milkshake theory. And let's say this red line is the pressure that's being applied, or the downward pressure on the dollar as a result of Bretton Woods 3, or the world de-dollarizing like we've been seeing in the news and I've been doing a lot of whiteboard videos on. Well, again, these cross currents are occurring at the exact same time. So it's not a matter of which cross current we have. It's just a matter of which cross current is more powerful. So if you look at the next 6 months or year timeline, so the short term, and although there are no certainties, only probabilities, I think that the dollar milkshake theory will apply more pressure or have more power than Bretton Woods. Therefore, my base case is that the dollar goes higher. Why? Because of the war that we see with Russia and Ukraine, and how this could get much, much worse if the United States or NATO gets involved. On top of that, we have the inversion of the yield curve, the euro-dollar future curve inverting, and a lot of these other topics that would lead us to believe that a recession in the United States is highly probable. And if we have a recession in the United States, that's going to create more demand for the dollar. But if we look at the long term, let's say the next 5 years and out, I think it'll be the exact opposite, where the Bretton Woods 3 will be far more powerful and it will overwhelm the pressures being applied by the dollar milkshake. And I don't know that I'd go so far as to say that the dollar will go down dramatically against the euro or the yen. Maybe some of these emerging market currencies, or maybe the yuan or the Russian ruble. We'll have to see how it plays out. But I know one thing for sure is that moving out 5 years, 10 years, the dollar will go down significantly against goods and services right here in the United States. So the dollar milkshake theory has not only begun, but it started a long, long time ago. And we are seeing a lot of signals that would lead us to believe the probability is high that we go into a global recession, if not depression, in the very near future. This would make the dollar go up even higher on the DXY, which would make the global depression even worse. For more content that'll help you build wealth and thrive in a world of out-of-control central banks and big governments, check out this playlist right here, and I will see you on the next video.